Hello, and thanks for joining. My name is Carola Jeppesen, and I'd like to welcome you to today's panel, Need to Know, How to Prepare for the New Era of Sustainable Investing. So to give you some context for my role in this discussion, I head up U.S. signatory relations for the UN Principles for Responsible Investment, the leading investor-led initiative for responsible investment with over 4,000 signatories across more than 80 countries, collectively managing over $100 trillion in assets under management, or more than half of the world's investable assets. The term ESG investing was coined in conjunction with our founding in April of 2006, and we've therefore just celebrated our 15-year anniversary. The 6 PRI principles provide a framework for integrating ESG into investment decision-making and active ownership. So I'm thrilled to be joined by 3 very distinguished panelists, all leading voices on sustainable investing. We have Chris Ailman, Chief Investment Officer of CalSTRS, which at $299.8 billion is the second largest public pension fund in the U.S. We also have G.Trotsky, Executive Director and Chief Investment Officer of the $90 billion Massachusetts State Pension Fund, MassPrim. And last but not least, we have Carola van Lamoen, who leads Robeco's global sustainable investing activities and their Sustainable Investing Center of Expertise. Welcome, everyone. To understand what's coming next in sustainable investing, we should understand where we currently are. So first, I'm going to be asking our panelists about current best practices in sustainable investing. What are the expectations that asset owners are setting with their managers? And what are the key challenges investors are facing in implementing effective ESG strategies? And afterwards, we'll discuss some of the most important developments in the space, and we'll finish off with a look into the future. So Chris, I'd like to start off with you. CalSTRS is one of the PRI's longest-standing asset owner signatories, having signed the PRI all the way back in 2008. And you were already committed to sustainable investing practices well before that. I think it's fair to say that you really have helped chart the path for other investors of sustainable investing in many ways. So could you tell us, what does sustainable investing look like today at CalSTRS, and why have you chosen to dedicate resources to doing this? What do you see as the investment argument for sustainable investing, and how do you communicate your expectations around ESG to external managers? Chris.
Thanks, Carol. Great question. Sustainable investing is incorporated into our entire investment process. So every investment manager is asked questions about ESG and how they integrate it. Every asset class has ESG integrated into its investment policy, and the overall fund has ESG. If you break the components up, we have dealt with S issues all the way back to the 1970s. They seem to be very episodic and very specific to the individual issue. We've been very active in governance starting in the 1980s and have a dedicated staff to corporate governance and a long track record of engaging companies on things like board diversity, their corporate board accountability, audits, all kinds of things. The biggest effort, and I think the one going forward, is without question going to be E on climate change. We really got active in about 2002 with addressing climate change. It's now a huge issue for us, measuring our exposure to carbon and especially to climate risk of what's the physical risk. So we continue to look at S issues that come up that range from geopolitical conflict to diversity to medical treatments, just a variety of things. Governance is a never-ending struggle with corporations to keep boards accountable. But the E issue is where we're putting a lot of money to work in climate solutions, and then also shifting away from carbon-based areas to reduce our portfolio.
Great. So Michael, I'd like to turn to you now. MassPrim has been among the best performing public pension funds in the U.S., and I've heard you say that strong returns really represent pension security for your over 300,000 beneficiaries. So you're very well known for having a highly quantitative and data-driven investment approach. How has this been factored into MassPrim's approach to ESG integration? And what have been some of the key challenges, either on data or otherwise? And also, like I asked Chris, what do you see as the investment returns-driven argument for integrating ESG?
Well, great. Lot of great questions there, and I appreciate it. It's great to be with my fellow panelists. Great to see you again, Chris, and nice to meet you, Carolina. But a lot of great questions. And first, we believe that companies that operate with consideration to ESG issues are higher quality and should outperform over the long term. We believe that. And as Chris accurately said, a lot of investment firms have been considering ESG factors for a very long time. Governance, social, the composition of boards, how they treat employees, how they treat their communities are all very important considerations. They have been for a long time. However, recently, and you're right to say that we are quantitatively driven here at Prim. My background is really as an engineer. I started out in California at Intel Corporation, and I've always used quantitative tools. And as a result, we are data focused here. And, now, even though there are $30 trillion of assets being attracted to ESG, we still think it's in its infancy in terms of robustness. And as we see it, there are three big problems today with ESG investing that we're really trying to sort out and we're trying to become leaders in. The first, and it's been written about more recently, is the quality and the consistency of ESG data on which to act on. That's number one. Number two is how to reflect the views of a large and diverse set of beneficiaries. At Mass Prim, unlike Chris, who has all teachers, and they tend to lean a certain way, we not only have teachers, but on the other end of the spectrum, we have policemen, firemen, laborers, and people whose ESG views vary. So the second problem is really trying to reflect a collective view on how we would like to approach ESG. That's a problem. And then the third is really that we've looked at a lot of products from investment managers, and honestly, they haven't been so robust, mainly because of the first two factors. The ESG data that they're built upon is not consistent or of high quality, and secondly, it's hard to determine which of those factors we should be most focused on, given our diverse board and a diverse set of beneficiaries.
Okay, great. Thank you very much. Well, thanks for those great perspectives on the current state of responsible investing from two of the US's largest asset owners. So now let's shift focus a bit to the investment manager perspective, and particularly from a European manager with some pretty advanced practices around sustainable investing. So Carola, now we'll turn to you. Robeco has been a PRI signatory since 2006. And I'll congratulate you for being selected as a member of the PRI Leaders Group for your work on climate reporting in 2020. So could you tell me what are the core aspects of Robeco's sustainable investing strategy today? And in particular, I'd love it if you could touch upon your approach to climate transition.
Yes, thank you very much, Carol. And indeed, Robeco is focused on sustainable investing for over 25 years. And we started to integrate ESG and engage with companies when no one did this yet. And also even when companies didn't know what to expect. So that long history helps us to remain a leader in SI, and we're constantly looking for next steps. And I would like to tell you a bit more about 4 important priorities for us that are top of mind, which is indeed carbon, but also our focus on impact, on active ownership, and on partnerships. So first of all, Chris already talked about it. Carbon is a big thing, and for us also a big focus is in the company on reducing carbon and combating climate change. We have set a net zero ambition across all our assets under management for 2050, and this is challenging, and it's also impacting in many different ways how we invest. We have to we work on establishing decarbonization targets. We have climate engagement with the biggest carbon emitters in our portfolio, also jointly with others. PMs have to work with carbon budgets. We already talked about climate risk. How does that impact the work that we do? And of course, also carbon tooling is important there. And to put this a bit in broader perspective, what we heard from a recent survey is that 86% of investors say that climate will be at the center of their investment policy or will be a significant factor within the next 2 years. So we're not the only one, but we try to be in the lead. Then impact. A second focus for us is really focusing on creating real world impact, next, of course, to delivering financial returns. It is a strategic pillar and it comes to life in the amount of assets that we have in strategies that have a positive impact on the Sustainable Development Goals. We have established a proprietary framework for that, and it also requires us to report transparently on the results of our activities. So that was number 2. Moving on to the third priority, we have a huge focus on enabling change at invested companies via active ownership. There is a growing momentum to collaborate jointly in the sector, and we're happy to join the collaboration, and we take the lead on several dialogues. For example, in Climate Action 100+, which is a massive collaboration with currently already 575 investors and 54 trillion in assets under management. We have, for example, been instrumental in getting a climate competent director on the board of Enel, and we did that jointly with many others. We do it in a structured way. We're not only focusing on climate, but also on topics like living wage, human rights, and biodiversity, and always with a strong focus on results. The fourth priority for Robeco I would summarize as building sustainable partnerships. It's at the core of our strategy. We're committed to help clients and broader stakeholders in their sustainable investing journey. And that means that we do a lot of knowledge sharing with them as partners. So we educate clients how to decarbonize their assets, how to set progress on their sustainable investing approach. And we also partner with academics, for example, Cambridge and others. Very challenging. All in all, I have to say we're very focused and committed to make sustainable investing work.
Great, Carola. There was really a lot of good information there. Particularly, I'd like to draw out 2 important areas that you mentioned, climate change and active ownership, which really are 2 of the most important areas of focus within responsible investing today. So it's increasingly acknowledged that active ownership is one of the most effective mechanisms to reduce risks, optimize returns, while also having a positive impact on society and the environment, both for passive as well as for active investors. It's also included as PRI's second principle. So in recent years, as you mentioned, we've seen a trend that many investors are not going it alone, especially on climate change issues, which is really reflected in the rapid increase in the number of asset owners and investment managers joining collaborative investor initiatives, such as the Net Zero Asset Owner Alliance, the CA 100 Plus that you mentioned, the 30% Coalition, et cetera, many more, as well as collaborative engagements via the PRI and our collaborative engagement platform. So Chris, CalSTRS has really been a leading participant in several of these initiatives. Why do you see the collaboration piece as being so important?
You know, it's absolutely critical. When you look at the holdings, let's take the USA as an example. There's a lot of money now in index funds. So as a public pension, ourselves, and obviously in our state, we have CalPERS, the number 1, number 2 largest. We still together typically only own about 0.8% of a public company. That's just not enough to move the needle. So we need to band together with other institutional investors, other like-minded, and really, frankly, influence the big 3 index providers, BlackRock, State Street Global Advisors, and Vanguard, because together they typically own almost 15% of the voting stock. But you're seeing, just with the groups that you mentioned, a much more effective use of shareholders working together to engage in a dialogue. If people don't care who takes the lead or who takes the credit, we can get so much more done. And I think this proxy season of 2021 in the USA has been absolutely remarkable with the amount of shareholder resolutions that have been adopted, the amount of board changes that we have seen where shareholders have actually proposed board members. And in Europe, it's already a very strong dialogue. And the European funds have been working together And now we truly have global with the Australian funds, with GPIF in Japan. It represents to where around the world we are now massing close to 5 to 10% of the shareholders' votes right away. And so when that coalition comes and knocks on the door of the CEO, it has clout. It has some weight that the board has to listen. And I think you're really seeing a dramatic change. Not everybody agrees on every issue, so you see coalitions naturally ebb and flow, but that's a good thing. And I think that chorus of voices, instead of singing a solo, a chorus of voices really gets a company's attention. It really makes them focus on a number of issues, just like Michael said. It's about managing risk into the future. We call it ES&G, but for a company, it's a long-term business risk. And when you use their language, they really get it and they pay attention.
Great. And continuing on that theme of the current proxy season, Chris, would you mind touching upon the recent proxy fight at ExxonMobil, where the election of 2 new climate-aware board members is really being called a watershed moment for climate change? From an early stage, back in December of 2020, CalSTRS expressed support for the alternate slate of board members that was put forth by a small activist hedge fund, as you know. Do you think we're going to be seeing more of this type of active ownership in the future?
I do, and I think I'm glad you brought it up. I think May 26th in 2021 is going to go down as a kind of plant the flag date that shareholder activism. So it's a little bit of a take. There have been activist managers, and they've been frankly more like corporate raiders, but shareholder activists taking it up a notch of working together really demonstrated. It was remarkable. Engine One is a very small firm that had a small position, but they came to us very early and talked about and asked for our support to help them. And we've been engaging Exxon. New York Common engaged Exxon. CalPERS engaged Exxon and got nowhere. But then teaming up and working with a number of investment firms, it really was absolutely remarkable to see the change because, believe me, they fought us. But we had numerous discussions that this wasn't about a war in the boardroom. It was about a change of culture at the top. And many times leading up to this vote, and I'm thrilled that we got 2, and I think we'll get a 3rd once the votes are finally counted. But I think what amazed me, and I said many times to the media, they asked about whether we would win or not. And I said, we had already won because ExxonMobil's CEO started talking about carbon sequestration, started talking about the Paris Accord way back in December. We changed the dialogue at that company that was previously just all about drilling and all about just, oil exploration at the ever far-reaching edges of the earth. And suddenly they're focused on a low-carbon future. Now we have to keep them accountable and hold them accountable. But I think, when you look at May, last week of May was remarkable for integrated oil, publicly held integrated oil companies around the world, with regulation on Shell in Europe, the proxy battles in the USA on Chevron, Texaco, and ExxonMobil. It really was remarkable. And it's the public oil companies that really have to define the future of low carbon. We can't rely on the Chinese, the Russians, the Venezuelans. They're not going to do it. It's going to be the publicly traded companies that we need to own shares of to really change their culture and get them to wake up. But for us, that was a big effort. I got to tell you, our board was very nervous about this, being out front, being vocal, taking on a huge firm. As I said to my staff, shareholder activism for us, we were good at hiking, but now we're going to go mountaineering and take on a giant hill. And they picked ExxonMobil, which was like, going after Mount Everest to me. So I'm thrilled that we achieved the goal. And now it's going to be up to those directors to really change the future of that company. And that's going to show that this is a value and it's going to add to our returns.
Fantastic. And Michael, at MassPrim, what is your view on these collaborative initiatives?
I also share Chris's optimism that this is happening more and more. And for the past 8 or 10 years at Prim, we've been the board has been agreeing on a very progressive and active proxy voting policy that aligns with many of our peers and pushes these agenda items forward, not only in environmental, but also in corporate governance. We're seeing more and more diversity on corporate boards, which is a wonderful thing, and that seems to be gaining traction. So I couldn't agree with Chris more that this is a watershed moment where asset owners are banding together, adopting like-minded proxy voting and activist agendas, and are being successful.
And then Carola, as an investment manager, Robeco has signed on to many of these initiatives as well. How do you balance your commercial interests in using a strong stewardship practice as a key selling point to asset owners with any challenges that might be associated with collaboration with some of your main competitors? Is that a challenge at all?
Well, I do not see this as a challenge. I see a strong benefit of collaboration, and we should not underestimate the power of collaboration when we engage. So I'm happy to engage with like-minded investors, and we see that is happening and it's having an impact. And of course, several great examples were mentioned already. I would like to add another one to this. What we did this year jointly with other shareholders was that we co-filed a shareholder proposal at Tesco, the UK supermarket, and we focused there not on climate, but here on setting targets for increasing healthy food sales. And the message that we gave here to Tesco and to other supermarkets is that shifting sales towards healthier options is important. And what happened here? Prior to the shareholder meeting, Tesco set new targets to sell healthier foods, and it was a great success. And after that, we could withdraw our proposal. So it didn't make it up to the shareholder meeting, and it was covered in many media. So you see here across the board again the power of collaboration. We've seen great examples from a climate perspective, but also social topics and governance topics. I see there the growing influence of investors. So happy to be part of that and lead on many joint initiatives.
Great. Thank you so much for that fantastic example. And indeed, it has been a fantastic proxy season for ESG issues, with a lot of successes across the board in varying ESG issues. So let's shift topics a bit to social issues. So the last 15 to 18 months have been truly extraordinary in many ways, from the unprecedented global health crisis and economic fallout caused by the pandemic, which has disproportionately impacted people of color, to massive protests following a flood of racially motivated violence in the US. Pervasive social issues like systemic racism, uneven access to healthcare, and economic inequality have really been brought into the spotlight, including within the investment community. So as we all grapple with the questions of what roles and responsibilities do investors have in all of this, I'd like to ask, Chris, first off, CalSTRS is the largest pension fund in the world for teachers, which is a group that really has been on the front line of the pandemic and highly affected by these issues. So I'd like to understand, how have your beneficiaries informed your thinking on sustainable investment?
As Michael said, we do get the chance to cover just public school teachers. 72% are female. And they're not a perfectly homogeneous group, but they really are focused in on the future. And we hear that loud and clear coming back from them. I mean, when you think about a teacher in your life, they're passionate about children. They're passionate about educating them for the future. And so it's absolutely critical to them. And this has been a brutal year. Thank you for pointing that out. We have actually seen a big increase in retirements. The teachers that are in the baby boom really don't want to teach over a video screen and don't like the technology. And so we've had a 20% jump in retirements this year. But what we're also seeing is teacher passion to get back in the classroom. We're hearing from them when it really comes to long-term sustainable issues. I've often said, I've been at CalSTRS for 20 years. When I got hired, the board said, we need you to make a return. You need to make money, but you got to do it in a really nice, gentle, kind way. And I pointed out capitalism isn't kind. And so there are friction points where, we have to invest in areas to diversify the portfolio that their views may not agree with. But what they find is that because we're focused in on the future, because we have to make that 7% return year after year for 30 years, we actually are aligned about looking out to the future and getting companies and our investments to think much longer term. Doesn't do me any good to make a high profit just in 1 year or in 3 months because I've got to do it again and again. So I often say this is a marathon. And I think when you really talk to corporate boards and investment companies, they want to be long term as well. And they really have to stretch out their thinking away from quarterly profits or quarterly returns like we do. We don't look at one quarter returns. We hold our money managers accountable for market cycles and longer time periods so that we're trying to reinforce that long-term thinking. And I think that's, when you think about everything I've said, take away that it's about thinking long-term, which is tough for human beings to do. We live moment by moment, but thinking long-term and investing long-term is the way that we generate wealth and that we build for their retirement.
Yeah, I really love the way you describe that as a marathon, and certainly that's very much aligned with the time frame over which many ESG issues play out. So very well aligned with sustainable investing in general. Michael, just to turn to you, I know that Mass Prim has really made a lot of progress recently in increasing your allocations to diverse managers, as well as increasing the diversity within your own staff. Could you please talk about that a bit?
Yes, it's. Thank you for asking too. It's been a major focus. In January of this year, our state legislature passed a new law which includes a provision to include the diversity of Prim's investment managers and contractors to at least 20%. And really, we're well on the way to that already. We have had programs in place for about 6 or 7 years right now, and we've made substantial progress. This new legislation gives an avenue for smaller, more emerging, diverse managers to do business with Prim. It hasn't been easy in the past, and it hasn't been easy across the globe, but we're hopeful that this new initiative called the Future Initiative will allow more participation. Over the past 5 years, we've successfully increased the use of diverse managers. One of your competitor publications, whose name I won't say, just recently ranked us number 6 in the country in terms of the dollars in assets we have with diverse managers. 5.3 billion of our 90 billion, that's nearly 6%. Is allocated to diverse managers. We have 5% in public markets, 20% in hedge funds, diverse managers, and 11% in private equity. So that's without this new program, and we hope this new program will encourage and allow us to hire more smaller managers who are having difficulty getting traction. And you're right. Internally, we're 66% diverse. It's been a major focus of ours. And that's up substantially. And we're making an effort to increase that even more, particularly at the senior level. So it's been a major focus of ours. And by the way, it does tie into the ESG discussion, absolutely, because we view ESG as not only an external focus, figuring out how our investment managers and our investment program reflects ESG beliefs, but we have to reflect it internally as well. And there's an equal focus there too.
Absolutely, couldn't agree more. It's an increasing focus, I would say, within the sector, of focusing on the managers themselves and what their governance practices are and diversity statistics, et cetera. So that's fantastic progress. So thank you. And Carola, how has the global health crisis and social unrest changed your approach to sustainable investing, if at all? Has it increased your focus on social issues, for example?
Well, the short answer is yes. It has increased the focus, and I'm glad to see that it not only has increased our focus on social issues, but it has happened across the globe. And I'm happy with that. It's also more on the mind of our clients. We have good conversations at this, and there is also a growing awareness that social issues are also financially material, as the COVID pandemic has shown. And for us, making that very concrete, this year we have started several new engagement teams with a social angle. So we focus on labor rights in a post-COVID world. How do companies prioritize health and safety, for example, in exposed sectors like the gig sector? But next to that, an important topic for us also is human rights due diligence. So how do companies take care of the human rights issues? Do they have good due diligence in their supply chains? You could think, for example, of textile companies. How do they deal with this? And tech companies. And another topic I would like to mention here, which also popped up more in the COVID pandemic, is the gaming industry. So we also focus on the social impact of the gaming industry. Those with teenagers in the room here, could know a bit about the addictive nature of some of games. But at the same time, we also see crazy working hours in the industry of people who actually work at gaming companies. So how does the company in this industry take their responsibility? So those are some examples of topics where we focus on. And I think, I can clearly see that COVID has accelerated the focus on this globally.
Very interesting, and some diverse examples there. And certainly at the PRI, we've had a work stream since the beginning of the pandemic, helping our investor signatories really understand the financial materiality of these ESG issues tied to the pandemic, and really what is the investment argument for focusing on these things, and really what is the tie to real world impact as well. So good. So before we end, I have a final question for all. So investing is really about looking towards the future. So for investors such as yourselves with long horizons, what are your expectations about the future of sustainable investing? So Michael, I'd love to hear your perspective first, particularly given your involvement with the CFA Institute, which is an organization that really helps set the standard for what constitutes excellence in investment practices. Do you see sustainable investing as here to stay? Will it grow in prominence? Will this eventually become part of the standard investment approach so that the terminology will go away and we can all just start calling this good investing? What's your thought?
Yeah, I think it is absolutely here to stay. There's more focus now than ever, and that's a good thing. And as I mentioned in my comments, even though there are $30 trillion to work in ESG investing, we still think it's in the infancy. And for this to be really successful, in my opinion, it has to be more robust. And PRIM's effort now is to find more robust ways to invest in ESG. And we're doing that through a collaborative process with MIT Sloan School in their aggregate confusion project. So we have a big belief that in order for this to be successful in the future, we need better data. Better data will lead to better outcomes, and better outcomes will lead to more and more investing in this area. And our goal is nothing short of being innovative and industry leading in ESG investing, and we will be.
Great. Carola, over to you. Same question. What are your expectations about the future of sustainable investing?
Yeah, I expect the growth in sustainable investing will continue to accelerate. We will see more focus, more collaboration, and also, we didn't touch upon that yet, more regulation. We see now in Europe that sustainable investing is being highly regulated with the sustainable finance regulation. I expect that will also occur more in the US, in Asia, across the globe. So we can expect more from that, and we can also expect strong policy responses from a climate perspective. So it will be an exciting future for sustainable investing.
Absolutely, and I agree with the policy developments. Certainly, that was something that was lagging a bit in the U.S., but we're now starting to see on the horizon more of that, and some evening perhaps between the U.S. and other regions. So that's a very interesting area to follow. So Chris, you get the last comment. So as one of the world's largest investors, as you mentioned, with an investment philosophy that's really focused on long-term patient capital, you mentioned how sustainable investing is really well aligned with that. So what is your perspective here? Sustainable investing is something that's here to stay. It's going to grow in prominence. Do you think that there's any potential that we'll all lose the term ESG and responsible investing, and we'll just be able to talk about these practices as being completely the norm as part of standard investments?
In a short answer, yes, I do. I don't know that we'll lose the terms, but I think that people will shift and start to change the word sustainable to think about just long term, as I mentioned. That companies and investors think longer term, not shorter term. And I would agree with what Michael said about reporting. We need investor useful data that's consistent, reportable, because what gets measured gets managed. And then with Carola, we're going to see more regulation and more focus on carbon and climate, because that is in front of us. Of E, S, and G, it is the E issues that are right in front of us and are going to be a material change to our lifestyles and to companies. And people either have to adapt or they're going to fall behind. And I think that's where you're going to see the investment is into solutions and investments, money flow away from the problem areas. But hopefully it does actually shift. I know the PRI at the 10-year anniversary talked about that maybe we wouldn't call it responsible investing. It's just investing. And I think that will be the future. Maybe what we'll substitute is that it's long-term investing versus short-term trading. And those are the real differences. But more money will flow this way, and it will become the industry standard without question.
That's great. Hopefully that's the case. A lot of optimism. I'm with all of you. a little biased in that regard, but certainly that's what I'm expecting as well. So with that, I'd like to thank the speakers for your really fantastic insights. It's been a great discussion. I'd also like to thank our audience, and please join us for the next session, which will be starting shortly. Thank you very much.